Any views or opinions expressed in this podcast are strictly the views or opinions of the presenter. Nothing in here is the view of the firms, corporations, financial entities that anybody represents. Nothing expressed here is a view of any regulator or semi-regulatory agency. All content is intended to be educational. Nothing in this episode construes specific investment advice, and if you do require advice, you should seek an appropriate advisor, be that a financial planner or a tax advisor or possibly a lawyer. And welcome back to the CE Drive podcast. This is Jason Watt. In this episode, I'll be talking to Jim Thornton. Jim's a financial advisor out in Ontario and had a bunch of questions here about sort of a scenario related to a high net worth client. Super interesting financial planning questions. The episode will be good for life insurance credit in all jurisdictions, a half a credit for your accident and sickness license in Alberta, a financial planning credit from FP Canada, professional development credit from IROC, an IAS credit, and a financial planning credit from MFDA. So let's start with the object here. The object is going to be a favorite book of mine that comes out once a year, every year. And this is Wealth Planning. Let's get it in there, in the frame. I don't know, I can't do it. Wealth Planning Strategies for Canadians, 2023. The camera doesn't want to focus on it, whatever. By Christine von Kauenberg. It's an amazing book. There we go. And Christine does just a fantastic job here of summarizing differences in provincial law. So, for example, how does marital breakdown work in Nova Scotia versus in New Brunswick versus in Ontario? What's considered a common law relationship in each jurisdiction? It's so good. It's actually a textbook for the CLU program, which you'll hear in the interview Jim is going through as we're having this conversation. So if you don't have a copy on your shelf, I don't think you necessarily need to buy it every year, although Thomson Reuters does have a subscription program where you can automatically get the new one every year. But at least every 2 or 3 years, I think it's worth having an updated version. If you're practicing sort of where you're delivering very technical advice, maybe you do want to update it every year. Okay. So I'm going to roll into the interview here, and then following the interview, I'm going to have some follow-on comments. I've got a fair bit to follow up on here, but you'll hear that we cover a lot of ground, and I think it's better to roll in and then hear some follow-on comments afterwards. I'm here today with Jim Thornton. Jim is a financial advisor based in Southern Ontario. Can you give us a little rundown, Jim, who you are, where you're at, that good stuff?
Yeah, I'm, as you said, I'm an advisor in Southern Ontario. Work with Asante Capital Management, and been in the business for, probably about 20 years now. In addition to financial advisor, I am a mortgage broker as well with a separate company. But yeah, and I've been doing that probably for about 18 years as well.
Interesting. I know you're a mortgage broker, and I always forget about that, Jim. So that's it. So do you have a sort of ideal client on the financial advising side?
I mean, our firm pretty much specializes in our local office specializes in more of the retirement planning. So we're basically pre-retirement into retirement. That's where we focus. We have some self-employed clients, obviously, and but that's the largest chunk of what we're doing.
And you were good enough today to reach out. You had some questions. This is not unusual. I'm going to ramble a little bit here, Jim. So where a student will email me, or a former student will email me with some questions about, this client, I've got this situation. And I'm going to say often the questions are very complicated, as yours is. And then I'll come back and I'll say, and I'm happy to talk about it, but I need more detail. Like, it's impossible to answer these questions with a lot of detail. And to your credit, Jim, you put together a very detailed summary of facts for me here. So this actually allows us to address some of the issues. Although, as I've already warned you, I think we're not going to be able to answer all of the questions.
Yeah.
So, I often think about these conversations as sort of, what can I deal with the client for, and then what are the conversations I'm going to have with the accountant? Is that fair?
Yeah, that's fair.
Yeah. And can you talk a little bit, like, in cases where you do have to deal with the client's accountant? I don't know. Is that something that comes easily, or do you find that it's a little bit of a challenge sometimes having those conversations?
I mean, I would say it's fair. It obviously depends on the client. So some clients are pretty guarded and don't really want to get into that. Other clients seem to be pretty open. So I'd say it's really a hit and miss thing.
Fair, yeah. And I can see why that happens, right? People sometimes feel like you're treading on their territory, or you're going to mess things up or whatever, right? So, um, okay, so we've got a summary of this client, and like you said, pre-retirement, right? I assume this person is not too far off of retirement because they're sort of early 60s, spouse is late 50s. What else do we have to summarize here? What else would be a key fact for this person?
I would say that wife is stay at home, husband high income earner, and works for a company overseas. So does a lot of traveling as a result. Still considered a Canadian resident, still Canadian citizen. So he's paying taxes overseas and then reports his taxes locally like he should be. So he's following all the rules. He's the type of person, he doesn't want to be overly aggressive on anything. Like he wants to follow the rules, doesn't want to run into trouble down the road. So he's got a corporation. I don't know how much detail you want me to go into at this point, but
Keep going. Yeah.
okay. So basically, situation is that he's got a large amount of restricted shares that his company has given him, which is a publicly traded company. And then he's just received more. So and then he's had a whole bunch of restricted shares become vested last year. So he's liquidated those. He's got some coming up for liquidation next year, and he just received a whole chunk more. So
can I just chime in on the liquidation of those shares here? Because this is a common problem, right? So you said now he's maybe a little bit, I don't want to say risk averse, but not necessarily risk loving either, right? I think that's fair. So did you find it was a challenge to get him to diversify away that position, or was this sort of like you suggested and it just happens?
I did, in the sense that it's very hard to talk to a client about diversification when their restricted shares have multiplied 30 times since they received them. So it's, yes, it was difficult in that sense, and at one point the conversation was, you really should start looking at diversifying. And their response back was, well, even if it drops by half, it's not a big deal, right? Then they experienced that drop last year, and it became a different experience.
Wow, that's tough. Okay. Can I delve into this a little bit more?
Sure, absolutely.
This is fascinating. Okay, so the drop actually happens. Like they have whatever, I guess the value would be, just looking at this, somewhere in the neighborhood of, I don't know, I'm guessing about, it peaked at 2 million, something like that. Then would it dropped off to about 1 million? I'm just assuming here.
Oh no, so their restricted value shares peaked at about 30.
Okay, there we go. I was, because I saw two different blocks of shares in here. So okay. Yeah.
The second block of shares that they just received, so it peaked at about 30. Half of them came up vested, so they sold them, but by the time they sold them, that was already down. I think it was down to probably around 20 at the time. So there was a lot there. So obviously it was a very different conversation by the time these came up for vesting. So
you feel like the client knows, like, is this I don't know, did they lose $10 million? Is that, or?
Oh, he's, so I say he, but I mean, I have a very good relationship with both husband and wife, but he's pretty much involved in everything. he's not, so you had mentioned risk adverse. He's not risk adverse. He's actually quite comfortable with risk and growth. So the volatility doesn't necessarily bother him. For instance, with recent markets, they've already started rebounding and things are already looking a lot better than they were. But I think he realized that, wow, this can change fast. So, I mean, as you know, being in this industry, everybody is high risk when the markets are going up, and they get a culture shock when markets are, let's say, volatile.
Right.
So,
Well,
yeah.
this is like, that's a fascinating case. I'm sure that, it'd be there's a lot going on there, I'm sure. So, okay. I mean, good that he didn't let it go any further than that, I guess, right? It's but that's tough. That's you wonder if he's always going to feel like there's $10 million sort of left on the table there, or if that's just, that's value of a lesson learned, or how that actually plays out. So
I think in his mind, he thinks it's, I mean, he's a critical, like he is really the key man in this company. So I think it doesn't really phase him. Like he knows what's coming down the pipeline. He knows all that kind of stuff. He's very high up in the company. So it's not so much of an issue for him. I think it was more along the lines of liquidating last year was more along to try and stabilize, secure what he's got here, and then future growth, whatever that ends up. I think now he's more in that position that it doesn't really matter, right? So whatever happens over there. So
this is a good reminder that we shouldn't assume too much that we know what's happening in the client. I know for me, I would be sick to, like, I would feel terrible, right? And it's interesting that and I'm not saying he sort of lets it ride, but that's, it doesn't obviously affect him the same way it would affect me. So good.
yeah.
That's good. Like,
he also
yeah,
has some RSPs, spousal RSPs. It's a little bit more heavy to her than him. They've maxed out on their TFSAs. They have a corporation. This is kind of what prompted me to reach out to you. So they have a corporation. So the way this worked is they started it off. They put in a 1.2 million. They bought a building. They bought an adjacent lot to that building. They renovated the building to be 15 units. Rented it out for a little bit until everything was finished, and then they ended up selling it. And so they had a cash influx into the corporation. They then had a subsequent sale for the adjacent lot. So they were able to take out the 1.2 million that they originally put in. While they had that there, they had shareholder loans that they were paying tax on, but the company actually didn't pay. So they've got now left over in this corporation about $1.5 million. And I'm trying to figure out what's the best way to get that money out of the corporation for them. Just to add a little bit of difficulty, they had a partner in this corporation, and so they want to sever that one shareholder who was a 10% shareholder. So yeah, and then the last 90 split evenly between husband and wife.
So roughly, I'm going to do a little bit of summarizing here. So we've got the original structure. They brought in that person from day one. So they came in at 45 shares each, and the third shareholder came in with 10 shares. That's right.
Yes. Well, it was all initial, right from the get-go.
Right.
So it was basically the person that helped them put those real estate deals together became the 10%.
I see. So that person was sort of taking like compensation in kind for their sweat equity, and your clients here, their equity was literal cash.
Correct. Yeah.
Okay, interesting. Now, do you have a sense, like, did they, with this advisor, this consultant that they were working with, was it then a structured deal? That person said, okay, I'll do the work, and then here's just the pro forma, incorporation documents or whatever, or did they use their own lawyer to do incorporation, or do you know anything about this?
I'm not too sure about that part of it. I know the clients have the corporate. I don't know if there's a separate corporation on that side. I don't know too much about it. It's really kind of like, let's do this deal together and you'll get 10% out of it type of thing.
So yeah, that's the kind of the question here, right? Is, and like you're going through your CLU studies as we speak, Jim, right? So you've seen some reference to like buy sells in there and paid up capital, repayment of shareholder loans, like that's all relevant to this case, right? So I guess then my question is, was there an original designed method for that 10% person to extract their value?
I'm sorry. No. So I don't think so, because they, I mean, for example, they don't have a second will. They don't. I don't believe there's a shareholder agreement in place. Things like that. So no, it
Right.
wasn't.
So
I don't think it was thought out too much on the exit strategy.
okay, and I would wager, I don't have a ton of experience with this, but based on some of what I've seen, like on financial Twitter or whatever, I would wager this is a fairly common thing with these real estate investments where you have parties who don't deal with each other, or who deal with each other at arm's length, who get together, don't do a USA, don't have a buy sell, don't have a clear exit clause, right?
Mm-hmm.
So I think you're right here. Like the first challenge is going to be, and I think this is accurate, the first challenge is going to be getting that minority shareholder out of the picture.
Yeah.
So do you know, have they opened up discussions with that person? Have they made an offer? Is there, or is this kind of where they're at? Is just figuring out how to do that?
That's where we're at right now. So the client came to me and said, we want to wind up the corporation, and we just want, basically, let's get them out. Like, it's not a matter of, can we get out of this deal? Like they want to just sever and kind of go their own way. So they originally, like, we want to wind down the corporation, open a new corporation with just us, and move money over and whatever. And that was kind of what their thought process was when we initiated the conversation. They haven't had a conversation. I know that for sure. They have not conversed with the minority shareholder. So
this is where you get into a challenge, of course, right? Because the minority shareholder, despite being in a minority position, does wield a disproportionate amount of power, right? Because they can, effectively, without a unanimous shareholder agreement, and if I can, for a second here, I'm just going to go down a path of the USA. So that's
sure.
Okay, Jim. All right. So if we have, and it sounds like you weren't dealing with these folks, like they did this before you were working with them, or independent of advice from you, or okay. So no criticism levied here, Jim, obviously, right? And I mean, if this this happens sometimes under an advisor's watch too. I get why this happens. So they partner up with this real estate advisor kind of person, and they create this entity, and they get into business with this person. Partner up's not a good word because it's not a partnership. And what should happen here is they should deal with a lawyer. So I said earlier, we'd say, when are you going to talk to the accountant? Well, this is when are you going to talk to the lawyer, right? So they should they should get together with a lawyer, and the lawyer should be advising them that they should have a unanimous shareholder agreement.
So actually, now that we're talking about that, sorry to cut you off. I did ask them about a shareholder agreement. They do have a shareholder. I know I said they didn't, but they do have a shareholder agreement. And apparently in that agreement, it does state that they decide what happens.
Good. Okay. So that, to my mind anyways, now depending on how broad that is.
Yeah, I haven't seen it though.
Okay, well, and I mean, honestly, they're going to need legal advice here. I would certainly not be comfortable interpreting that document and giving advice on the basis of what it says. And, I think that's probably something most financial advisors, you give it a cursory read or whatever, but no matter what, I think you need to bring a lawyer in. There's a couple things here. What you do has to be adherent to the shareholder agreement. It also you're in Ontario, it also has to be adherent to the Ontario Business Corporations Act. So these, and there are things we can do in the USA to override provisions in the Business Corporations Act, but that's the lawyer knows. I don't know what those are. So
yeah. And I
All
have
right.
had that conversation with them saying like, listen, we're going to need to get the lawyer involved,
Yeah.
but really this is kind of more of a high level conversation at this point. And then let's branch this out, and we're going to need to get your accountant involved as well. Like we're going to have to get all three of us working together.
Perfect. 100%. So I would suggest that there's, at least to me, and the lawyer and accountant might have other suggestions. I think there's two possible options here. And one is, like you say, to just dividend everybody out and sort of wind up the corporation. I think that actually what's cheaper to do, and I'm not 100% sure on this though, is to do a share redemption with the 10% shareholder, get that person out that way.
I had suggested that.
Yeah.
So I had suggested that we might be able to redeem the shares. They're a little nervous in the sense that they felt that it was a little disorganized with this person. So one of the things I guess they're concerned about is what will happen after the fact if they just redeem them and keep the company running. If there was a vendor that wasn't paid, for example, for one of their renovations or something, can they come back to them or whatever? So in their mind, they want this one gone and a new one over here, and they don't really care about the cost at this point.
Yeah, and that's potentially fair. You're right, like they are right here. That's very astute on their part, right? That they know that the corporation never really gets rid of its obligations. So there are some questions around this, around if they get rid of existing corp and create new corp, then how much of the liability of existing corp carries over to new corp?
Okay.
And I would say, and I don't know the case law around this in Ontario. I'm aware of a BC case where something similar happened, and the courts did allow the creditor to go after new corp.
Okay.
So that's one that doesn't necessarily have the full effect. Now, my and I've used this before in this podcast. My own lawyer, our corporate lawyer, always uses this analogy with this kind of thing, and I think this is useful. I think this might be a useful thing for your client to hear. So, if you have these kinds of things, like you're using a corporation to shield liability, right? You know that it can work, but you don't know that it will work. And it's like the chase scene in a movie, right? So you've got the person being chased, which might be your client here, and the person doing the chasing, which might be an aggravated vendor, right? A vendor who didn't get paid, or didn't get paid what they thought they should have, or whatever causes liability, right? This is the issue with land development. We haven't even talked about the business yet, but I know they did some land development, right? Yeah. And so now both parties are going to do whatever they can, right? Again, just like the chase scene in a movie, the person being chased, they run through a shop, they put on a disguise, they duck down a back alley, they climb a fence, and sometimes they get away and sometimes they don't. So every, obstacle you put in the way makes it harder for the person doing the chasing to catch. So, that's where creating that new level of corporation, it's like the equivalent of pulling on the new hoodie when you're ducking through the shop, right?
Yeah.
And I don't know if that rings true with you, Jim, but I watch enough action movies that it works for me. So
yeah.
So, and I think that's a good way to explain it to clients. When my lawyer explained that, I thought that's a good analogy. It shows you that you don't know how these are going to turn out, but you take reasonable steps.
Okay.
And it sounds like your client is looking to take reasonable steps.
Yeah.
That's fair. Okay. So I think this comes down to then the question of, right, do they create and this would be where presumably, I think this is how you would do it. You would incorporate a new corporation.
Okay.
And then you would use Section 85 and you would roll probably the shares of the existing corporation into new corporation.
Okay.
Take back shares of new corporation in exchange, and then essentially just pay the dividend up to the new corporation and wind up old corporation, having dividended up the old shareholder. And that's where you would be doing a share redemption anyways to the old shareholder.
Yeah.
So, or even if you're not doing a share redemption, you're effectively going to reduce the corporation to zero assets and then go through a corporate windup, right?
Okay.
And there's again, and the accountant's going to brief on this better, but there's a couple issues with that. So when you wind up the corporation, that requires then a tax year end. So there's costs there. And you do have to, if they're looking to reduce their liability, which they are, then you're going to have a wind up both on the tax side and a wind up on the legal side. Like the Service Ontario, I believe it is in Ontario, is going to want to see that wind up as well, right?
Okay.
So, and I don't know what that looks like. That's a good question for the lawyer. But there may very well be a requirement to do some degree of advertising for creditors to do that wind up.
Okay.
So that's a question for the lawyer, is sort of how much notification do you have to give to that prospective set of creditors before you wind up existing co. And, it could be one of those cases where if you just kind of let it slide, like let the existing corporation go, you stay under everybody's radar. And if you have to go advertise for creditors, you pop up for a second, and it might cause somebody to say, well, hang on a second, there's something there, right? So
Okay. Gotcha.
That makes sense.
Yeah, that makes sense.
Okay.
So
yeah, go.
Is there a way that, in your opinion, that they could utilize the capital gains exemption in this case? Like, I don't know. Like,
Right. So this is where I'm going to give, I don't always give this caveat in class, but often I do, is, we spend all this time learning about the lifetime, like, I'll go through the, whatever, we're $971,000 this year, I think 971,630. That's close anyways. Right, whatever it is. Or $1 million for farming or fishing property. So anyways, and we learn the 50% active, 90% active, like all these rules about what qualifies and what doesn't. And then at the end, I'm going to say, but in reality, it's actually a very difficult provision to use. It's
okay.
It's very hard to use lifetime capital gains exemption. You have to be doing, first off, and I know this is what you're looking at here, right? So you have to be doing a share sale, first off.
Yeah. Yeah.
Right. So the share sale, and that's sort of like what we could do here, right? What you're talking about, the taking existing co and rolling those assets into new hold co. That is a place where sometimes you can use the lifetime capital gains exemption. You can crystallize your lifetime capital gains exemption there. So
Okay.
in that sense, the question is a good question, right? Is could we pull that off? So I would say structurally you can. Now, the real only advantage to that is then the shares that you are holding in new co, like the new hold co, would have a higher ACB.
Okay.
And that higher ACB doesn't directly allow you to extract value from the corporation tax-free, right? Like ACB does not represent my ability to extract value from the corporation. For that, I need a shareholder loan like you had before, or paid up capital. There is a way to do a pipeline plan using that higher ACB and potentially extract that way. And this is where you have to go to the accountant. My understanding here, again, I'm not an accountant, is that ACB created by use of lifetime capital gains exemption is what's called soft ACB, which you can't necessarily extract. If it's hard ACB, see, two different kinds of ACBs, because why not? Then you can potentially extract that value, right?
Okay.
But that's something you're gonna have to run by the accountant. But I'm going to suggest that probably, like my warning, the lifetime capital gains exemption is probably not available here.
Okay.
And the issue you're going to run into is that the assets have to be at least 90% active at the time of disposition.
Okay.
And I don't think you're going to run that. Like now you're just dealing with straight cash, right?
Well, one of the issues that I was curious about is, would it even count as active business income in this, or assets, because it's property, it's rental income,
Yeah, and that's where the
question in
second,
the first place.
yeah, that the second test is the 50% active for the 24 months prior to the disposition.
Yeah.
And you're right. If the business really was in the business of being a rental business, and that's what they did, right? They bought property, they rented it out, they generate rental income, and rental income is by and large considered passive. And when it's passive, then you're right. You're not qualifying for lifetime capital gains exemption.
So in this case, because their intention was always to buy the building, it was never to hold this rental property forever. It was to buy the building, renovate it as a rental property, and then sell it for a profit. So would that not count as business?
Right. So this is the question then. Were they in the business of being land developers?
Okay.
Right. And in that case, then, this is where you get into some question about the rental income and so forth. And that's a tough one. And so you asked me the question, and I did some research around this, and it's a very difficult question to actually parse out. So this is where, like, 100% you're going to be stuck dealing with the accountant on this. And I would wager the accountant asks a lot more questions before you get to a clean answer on this.
So one of my cautions for him has been, like a while ago, I had mentioned, basically he's using an accountant in town, which is, let's say, more of a tax preparer. They're a CGA, but I'd say they're more of a tax preparing office than more of a planning office.
Right.
And so my concern for him is that I don't know if there's enough planning there for him to continue to use that accountant. So I did recommend that we need to level up here on the accounting side.
Yeah.
So
how's that conversation going?
He's a very loyal guy. So
Right.
I think he feels like he's kind of being disloyal by considering somebody else. But I'm just saying, like, it's not at the same level. Like it's a different level that you're looking at here.
And you said, I think earlier, you don't have a direct line of communication with this accountant right now.
Correct. Yeah.
Yeah, I'm hoping, because I get that, right? I think we should be loyal. I think that's a respectable attribute, right? I'm hoping that maybe you can open up this discussion with the accountant and say, like, can we bring somebody in for a one-off engagement to help do some tax planning around this corporate wind-up or whatever it ends up being?
Okay.
I think that might be the way to address that. And then you're not threatening the existing accountant,
Mm-hmm.
right? And the client's not, fearful of losing that relationship. And I think if the existing accountant knows that the client wants to continue to use their services, and that's what you want, right? Like,
Yeah.
and I get that there could be benefits to bringing, but realistically, if you're bringing in somebody from one of the, 4-letter firms or whatever, that might even get you into billing territory the client's not comfortable with. That kind of thing can happen, right? So, yeah, I don't know. To me, you need that team approach, and I think part of the financial advisor's role here can really be to manage that team, right? I don't know how you feel about that, but
yeah, and I think that would probably go over well with him, taking that one-off approach and saying, like, listen, you don't need to change accountants. Like, you just need more planning around this. Like,
yeah.
So.
And I think that's valuable, like to recognize that there are places where, and I mean, you do this, like, you're not picking stocks for that client to buy, right? Like, I assume you send them to, mutual funds or ETFs or whatever the case is. So you're like, they're using a team approach with you. They have a PM who, runs their money one way or another, right? So,
Yeah, exactly.
so yeah, so that's yeah, they're already doing this. They're using the team approach. They may just not recognize it yet.
So really, with regards to finding out, like, does this classify as a development business or a rental business or whatever, that's just conversation for lawyers and accountants? Or
I think that 95% of it is going to be the accountant digging into the facts here. And again, I mean, I found a fair number of articles about it. Even the Government of Canada website, like there's an old CRA website that deals with this, and it's a little bit murky. My instinct is to say no, but I hate to rely on that. I think that there are cases where I would instinctively say lifetime capital gains exemption is not available, and it turns out to be. So,
Okay.
yeah. And so that makes it a good question, Jim, right? When you first asked me the question, I thought rental property, probably not, but the developer thing here, I'm going to say then maybe. Now I am going to, and I warned you about this before, I'm going to throw one other caveat in here, one other warning around this, right?
Sure.
And that is that in that development space, and I think this is something we often overlook as like financial advisors, right? We think about income tax, we don't think about excise tax. So you're in Ontario, you're primarily dealing with HST. I think you have, it's not the same. I know in BC, they have this whole thing where there's some stuff that's HST and some stuff that's GST. I think Ontario, by and large, HST is there, and you don't have to worry too much about GST, right? But,
yeah, just very few things separate it. So
yeah. So the one question that I would want to fully address here is, if they were a land developer, did they properly pay or charge HST on everything they should have?
Okay.
And my experience with this, and I'd love to hear from tax folks who have maybe different opinions, but my experience with this is you're more likely to trigger some problem with CRA around HST than you are around income tax.
Okay.
And so, you're talking about risk management with this client, and that's a place where there might be a little bit of risk, and CRA will have no, you talked before about the old vendor showing up and having a debt that they're going to try to collect on now, or a contract they're not satisfied with, or something like that. CRA will have no problem on an HST issue because they can come right to the individual shareholder.
Gotcha.
They don't, they have no restrictions really in their ability to collect HST that should have been paid. So,
well, and that's obviously a good thing to bring up, but I would assume, which I really shouldn't do, that the minority shareholder will probably have taken that into consideration, considering they're involved in the development business themselves. So hopefully they would know their way around that, but it's definitely something to bring up with the client and make sure.
I think this is another avenue that you can bring up with the client's accountant to allow you to get to that accountant who's better suited for this particular transaction, right? To say, this other firm is, able to do I don't want to say HST audit, but to look at HST and make sure that we did it right.
Okay.
Yeah.
I'm just trying to.
So yeah, just to circle back to lifetime capital gains exemption here, if it were like a giant rental empire and you had more than five, I apologize, full-time non-family members working in that giant rental empire, then your rental business now qualifies for lifetime capital gains exemption. I don't think that's relevant here, but just in case people are wondering why lifetime capital gains exemption is not available, that would be it. Now, I think that you're good to have thought about lifetime capital gains exemption, because I think, Jim, you can play this card and say, look, this is another reason to bring in this tax professional with more experience in this area. I think that's fair.
Yeah, absolutely. And I mean, really, the idea of reaching out to you is like, is the possibility there? And I mean, rental, it's pretty, I mean, just from our previous conversations that we've had about other stuff or whatever, I knew that was pretty much, that was going to be a no-go. Where I wasn't 100% sure is just this whole, yeah, but they went into this to buy a business, renovate it, sell it. Like that was their business, not quote unquote rental. That was kind of a byproduct until they were ready. So I think at this point, at this point, it'll be conversation with the client. This probably won't work, but you can try it. Here's some things you should talk to your accountants about.
And I like it because there's enough other assets that, this is not a make or break for them. It's really more of it's almost like an intellectual exercise, right?
Yeah, exactly.
Yeah. Yeah. So it's a nice one. And it's a nice one to kind of, I think, to cut your teeth on lifetime capital gains exemption. Funny that you run into this just as you're going through the CLU program, isn't it?
Yeah, and it's funny that not only am I running into it, but like it's active, like they're in the process. So I'm not like, it's not a year down the road and it's not last year, like it's now.
Right. It's almost like if you navigate this case, you should just get your CLU, right? Like
there we go. So
okay, that's cool, Jim. I really appreciate reaching out to me about this. And like I said earlier, just laying out the facts here, I find this so helpful. And it's, like I said, a lot of times students will ask me and then I don't get the set of facts afterwards, which, I think just the ability to lay out the facts and get these questions down, I think that's a key attribute for a financial advisor, and really just to put the work in when you don't know what's going to happen in terms of, compensation or outcomes or whatever, that it's so important, right?
Absolutely. So yeah, I appreciate you taking the time and walking through this with me. I know I gave you a lot of information that wasn't really relevant here, but I just wanted you to have a full picture. So.
Thanks. It's all relevant. I actually do have one follow-on question here, and that's about the fact find. So sure. Is this just like for you, is the fact find a verbal exercise, or what do you have software you're using to assist you on this? What's the
No, this is basically conversation based and notepad and conversation. So no software at this time.
No recording the meeting, no assistant with you with the scratch pad, just straight up Jim and a scratch pad and notes.
Yeah, exactly. Sure. So I don't know if that's the right way, but that's the way I did it. So
I think the only way to judge whether it's the right way or not is to say, like, do you have the tools to arrive at a good outcome? And I think you do here. So yeah.
Thank you.
Okay. Thanks so much for your time today, Jim. Really appreciate it. And again, thanks for the question.
No problem. Thank you.
Okay. As I said, a lot packed into that interview, and I feel like I probably should have, had other questions ready here. Maybe I missed out on asking some questions about the client. I think that we could have had a more robust conversation about sort of risk capacity, risk tolerance, risk composure. I think that really shows up there where you have that discussion where the client says, yeah, I can afford a loss. And then when the loss actually happens, the client was able to afford it and sort of did, for the most part, weather it. They didn't run for the hills, but it did cause, I think, more pain than what the client had anticipated. And maybe it's just that they thought the loss wasn't possible. Maybe they thought their risk was greater than it was. It's hard to know. But it's a good sort of object lesson in the fact that we often don't really think about our capacity to take on risk until that material event happens. So that was great. The number, I should do the number. The number for today's episode is 8. The number is 8. Okay. So I wanted to follow up on a few technical items here, notably non-resident taxation. So I think most people will be aware of this, but it sounds like this client is earning income that's taxed in another jurisdiction. So they're a resident of Canada, but their job is really in another jurisdiction. And this is where we stumble into non-resident taxation. So what'll happen most likely, although there are some nuances here, but most likely they're filing a tax return in that other jurisdiction. This is where I'm quite interested, because Jim specifically talked about dealing with this accountant who's really just a sort of tax preparer. And I'd be interested to know if there's tax advice coming in the other jurisdiction and how that might play in. Might be some some gaps here in compliance, and that's where it might be good. Later on in the interview, we talked about bringing in maybe somebody from one of the four-letter firms, or maybe a specialty firm, somebody like Moody's Private Client or somebody like that. And that's where what should happen anyways is that income will be taxed in the other jurisdiction. You'll bring that tax return onto the Canadian tax return and say, look, we paid tax in another jurisdiction. We don't have to pay tax in Canada. This is a foreign income tax credit, and that's how we generally avoid double taxation. So that's intentional. I don't know what the other jurisdiction is. We have tax treaties with about, if I remember right, 107 different countries around the world, something like that. And that tax treaty is generally going to codify some of that treatment, although some of the tax treaties are surprisingly light. Some of them are just a page that sort of lays out some principles. Some of them, the US-Canada tax treaty, is quite long. It's really like a mini income tax act unto itself. Okay, going back to the risk tolerance, risk aversion thing, I'm always, when I hear a story like that, going to lean on Carl Richards. I love Carl Richards so much. I think the guy's incredible, just a genius. And he's got all these great quotes for sort of managing difficult client conversations. And the one that comes to mind when I hear stories like this, you've got a client who's got so much exposure to company stock, is how much better off are you if what you're doing works out versus how much worse off are you if what you're doing doesn't work out. So I think about, continuing to have this concentration risk. Well, really for this client, what's the difference between, a $30 million portfolio and a $40 million portfolio? Does it put them that much better off versus, a $30 million portfolio to a $15 million portfolio? Does it put you that much worse off? I think that kind of framing can help, where the advisor can plainly see that the client is exposed to more risk than maybe makes sense in their financial situation. Now, that said, we do have to work to put ourselves into the client's shoes. If the client is comfortable taking on that risk, great, but we do want to make sure that the client truly is comfortable there. Okay, we talked about unanimous shareholder agreement in there a fair bit. So just as a way of framing this, the unanimous shareholder agreement is sort of a substitute or a replacement for the Business Corporations Act. So there's a bunch of analogies for this. You can think about a will. So I don't need a will. Now, I would never say that in my own situation. I need a will, but legally I don't need one. There's no law that says Jason has to have a will. If I don't have a will and I die, well, I die intestate, and then intestacy law kicks in. And honestly, in Alberta, it's not the worst thing. Really what would happen here, probably, although my situation's a little tricky, but probably my property would all pass to my wife. We have adult children who might file a dependent relief claim. This would be interesting. You've heard me talk earlier in earlier episodes about sort of maybe some degree of dependency from some of our adult children. But for the most part, I think my property would just transfer to my wife. There'd be no real tax planning opportunities there, no opportunities to set up trusts or anything like that. So I don't want the default handling, but the default handling is available. So we've written a will to really override the provisions of intestacy legislation and create a set of outcomes that's more coherent with our situation. Well, similarly, the Business Corporations Act says that when you have a corporation, the shareholders interact with one another and with the corporation in accordance with the terms of that Business Corporations Act. Every province has one. There's a federal version of it. However, kind of like intestacy law, the Business Corporations Act is really, really thin. It doesn't do much, especially when it comes to shareholder disputes. Really, the only useful mechanism in the Business Corporations Act for a shareholder dispute is a provision wherein shareholders can ask the courts to force a wind-up of the corporation. So that's maybe not ideal, and who knows how that actually plays out. What we can do then is write the USA, the Unanimous Shareholder Agreement, and the Unanimous Shareholder Agreement can override those wind-up provisions of the Business Corporations Act and really can consider all kinds of possibilities. This is where the buy-sell agreement that so many insurance folks and that is really a heavy focus in the Chartered Life Underwriter course, that's where that buy-sell agreement will come in, where there will be some measures in there that say if the business owners don't get along with one another, what happens? How do they get rid of one another? Or there will be provisions for if there's a premature death or a serious disability or a loss of capacity or a loss of professional status or one shareholder not pulling their weight, okay? Anything like that, there's going to be some language in there. And by the way, the other CLU textbook, in addition to the one I mentioned earlier in the podcast here, is the Estate Planning with Life Insurance book by Glenn Stevens. It's another amazing book, and Glenn goes sort of section by section through what should go into the unanimous shareholder agreement and uses some examples of good language and bad language here. This would be a gift that the financial advisor could buy for the lawyer. And on that note, then, I want to segue here. I think this is a champion segue by Jason. Segue into how we get other professionals involved here. So Jim talked about this challenge where the client is dealing with a tax preparer who's done, sounds like an admirable job and does everything right, but isn't maybe dealing at the level of competence we need to deal with these fairly complex transactions that are on the table. So we don't want to disrupt that relationship. 100% we don't. So how do we do this without disrupting that relationship? Well, in the case of this accountant, I think first off, the thing to do here is for Jim to ask the client if he can reach out to the accountant. And it might be something of a difficult conversation, but to say, look, the client is getting into some stuff here where I'm not sure about the applicability of lifetime capital gains exemption, or I'm not sure all the cross-border issues are all the way addressed. I know these can be quite complicated. And again, you have to sort of ease into it. You can't sort of call out the accountant's professionalism right away here, or the accountant's competence or whatever the case is, but there's got to be a way to do this. Now, this would be much easier if there was a pre-existing relationship with the accountant and you could call up and say simply, the client's willing to spend some money here. Maybe we can bring somebody in to advise specifically on this transaction. Don't worry, you're not going to lose your client out of it. Okay. And it sounds like the client's very loyal. And I think it's good to remind the accountant of that there's this good loyalty there. Now, just circling back to the lawyer then, and why I mentioned the lawyer here, because the lawyer is, I would suggest, seldom going to take advice from the financial planner, although I've certainly heard it. I've heard cases where the lawyer says, I'm going to lean on you to tell me how that's going to work in practice, and that's fine. But one of the things that I like here is that book I just mentioned, Glenn Stevens, who is a lawyer himself, his book, Estate Planning with Life Insurance. This book would be a great one to buy and give to your lawyer friends, your lawyer centers of influence. It's expensive. It's about $200 a copy. But in so doing, it's not you telling the lawyer how this is going to work. It's another lawyer telling the lawyer how this is going to work. I think it's a much better outcome. And it is a very good book. It's well written. It's well laid out. It has a bunch of stuff in it that is executable where we could actually follow up on it viably. Okay. So I hope that's all helpful. Little bit more sort of lecture by Jason than I might like in this episode, but that's going to happen sometimes. I hope that you'll join us again in 2 weeks. We're going to have actually a lawyer of all things, an estate planning lawyer. We're going to have Jordy Ayton from Estate Planner. A lot of you might know Jordy. He's quite prominent on YouTube or in podcasts. He's often linked up with the Hull on Estates YouTube channel or podcast episodes. But he's got this fantastic tech tool, the Estate Planner, and I've been playing around with it a little bit. It's really top notch. So enjoy your continued studies, and please join me again in 2 weeks when we're going to talk about visualization in estate planning. Hi, if you're listening to this episode and you're not already signed up for CE credits, this is a very easy thing to do. Just navigate over to businesscareercollege.com and you're going to sign up here for CE. just subscribe. Currently, the pricing is $200 a year. We may be introducing monthly pricing at some point, but as of today, we have a cost of $200 a year. And once you're signed up, then you can just go and listen to every episode within your subscriptions. So you'll use once you're logged in, you'll use my subscriptions here, and you'll just go to the latest episode, which you'll scroll down to very near the bottom for. It doesn't matter which episode, you just scroll down and you find the one. So as of the time I'm recording this, the most recent episode is season 4, episode 27. I can just start it right from here. I can do the quiz here. Once I'm done the quiz, then I can get my continuing education certificate. Very straightforward. So I would just launch the course here, and I can watch the episode from here. Now, if you happen to be already listening to it on YouTube or whatever the case is, you can just navigate right into the quiz. You start your quiz, and you're just going to go through the whole thing. And then at the end of it, you'll be able to see your certifications. So we're going to bring up designing small group products. We bring this up and we click on wall certificate, and that's going to give me the CE certificate I need in order to maintain status wherever I happen to need CE credits. So I really do encourage, I know that out of our regular listeners, about 40% of you are listening to the episode for CE credits. That's about 60% who are listening out of general interest or whatever it is. And I really think this is an easy way to get your CE credits. $200 a year, pretty reasonable price. And as you can see from the certificate here, and as you hear me discuss at the beginning of the episode, we have a broad range of approvals for all of our courses. I'd like to thank Joe Tong. Joseph is our editor, both for video and audio content. And Joe does a lot of good work to make sure that these episodes look and sound good, despite my better efforts. I'd like to thank Maria Nguyen. Maria makes sure that the episodes all get approved for CE credits. Veronica Thibert does the quality assurance through that process. And then we have a strong marketing team that makes sure that all of our content gets out there so that people can find us and take advantage of the learning opportunity they might not have known about.